Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to kick things off today with the economic data that's coming over the next couple of weeks because we do have some pretty consequential reports coming. And also over the past 3 weeks, since we last did this, there have been a number of reports that came in that show the economy turning from a growth mode potentially into a slowing mode. And this would indicate that the Fed's recent moves to not increase interest rates again and stand pat and leave open the possibility of again pausing, as we get into December, that is potentially the right move according to what market participants appear to be saying. The interest rate futures markets, in fact, are pricing in no more hikes for the rest of the year, and they're pricing in potential cuts to the interest rates as early as May. And what that means is they're potentially expecting stress on the economy to cause it to go into recession by then. So we would be watching these signs, the next upcoming batches of reports over the next couple of months, to determine whether it indicates, yes, we're headed toward that recession, or maybe the Fed can achieve that very remote possibility of what's called a soft landing, or a rate hiking cycle that does not result in a recession. And while we're hearing that term bandied about on the media, it's really important to realize the history around that concept. In all of the attempts that the Fed has made over the years, since it's been measured in this manner in the 60s, since research we've looked at, they've achieved one soft landing. So, is the historical probability saying that they're likely to get that this time? No. We take with a large grain of salt, whatever's being said on the media right now, that indications show we're looking at a soft landing as being likely. So getting that out of the way, let's talk about these reports coming up over the next couple of weeks, some of which are consequential, including later today when we get the leading economic indicators index, which is expected to show a decline of 0.7%. Now that indicates that GDP is expected to contract by about, almost 1%. And that's pretty consequential. That does suggest a slowing economy is in our future. That indication, or that indicator, is predictive. We get information on the real estate market coming in dribbles over the next couple of weeks. Demand situation, and this is important. The last time we got durable goods, that was expected to, that came in at 4.6%. And it's expected to come in showing that shrinking by 3.2. That's a pretty significant about face. We'll be watching to see if that happens because, consumers tend to pull back on the big ticket items that durable goods represents when they're expecting a turn south in the economy. So we'll see what happens there. Does this number come in better or worse than expected will inform our view as to whether we're headed toward recession or whether potentially the Fed has more work to do. If demand comes in strong, that would be indicating that inflation is not necessarily under control despite what we've seen recently. So in any case, let's step back for a second and say the picture is very confusing. We're getting some data that appears strong, some data that appears weak, but there is a greater proportion of the weaker data coming out. So it is tilting in that direction. We get more information on sentiment. We get information on, consumer confidence. That one's big. This number that it's expected to come in at 100.3 is still a positive number that indicates expansion, but it is slowing from its prior reading of 102.6. So we're going to be watching consumer confidence since consumer spending is such a big driver of gross domestic product. We get gross domestic product second look, which is expected to be written up by 0.1% to 5 for the third quarter. And we get more information is coming in particular of pretty good importance regarding what the Fed is thinking is this PCE core deflator number, which is expected to show a 3.5% increase versus a 3.7% increase in the prior reading. While that is some deceleration, that is still a very high number relative to the 2% official target that the Fed is talking about. So, are they content with 3.5%? Yeah, it looks like it when we look at the yield curve later. We're going to talk about that, but it does look like they're content to let inflation run a little hot for now. This could be dangerous down the line if there is a recession that does not cause inflation to go down, which is technically called stagflation, and it's something we haven't seen since the 1970s. We could potentially see that again. And so we're watching inflation very carefully, and so is the Fed. If that were to happen, the Fed would be in the tough position of having to raise rates to slow the inflation down at the same time that the economy is shrinking, which would accelerate the shrinking economy at that time. So we're watching for that one pretty carefully. That would be a pretty bad grouping of events. So moving into later on, we get more information on demand and supply, more information on the labor market and inventories. Inventories we watch pretty carefully because, if inventories are growing at the wholesale level, that means that the retailers are buying less inventory. Or alternatively, that means the wholesalers are gearing up and producing just more and more in anticipation of further demand. Either one of which could be potentially problematic because if they're gearing up for, future demand at this time, that means that they're not believing these weaker signs in the economy and that they're thinking we're still seeing inflationary levels of demand. On the other hand, they could be, growing inventories because the retailers are buying less. They see signs of recession and consumers pulling back, which would be the more likely scenario. So we really need a good Goldilocks number here, and we don't have that expectation out yet. We're just going to have to watch and see. More labor market and sentiment index, rounds out the next couple of weeks. And what's happening with interest rates? Well, the yield curve has come down pretty dramatically. This green line is where it is now, and the gold line here is where it was, a month ago. And in the past few weeks, we've had these reports that suggest interest rates can potentially come down because inflation is potentially coming down. And ultimately, interest rates are driven by inflation expectations when you're talking about the risk-free asset or the U.S. Treasury bonds. And so, this decline is pretty meaningful. Over the last month, the 10-year note is declined about 44 basis points, and the 30-year notes declined about 45 basis points. And that's a pretty significant downward shift. So, we'll see what happens with that. That indicates potentially, when you look at this yield curve, there's a story being told. And the story is the Fed is going to stay put. That's what this horizontal portion of the curve in the short end looks like. And then eventually it's going to bring rates a little bit lower, but not necessarily down to 2%. And we think where rates are right now suggests that the market participants that make things move are in agreement that the Fed is actually targeting about a 3 to 3.5, maybe even 4% longer term inflation rate. So we're watching that one to see how the curve changes. But by and large, the story is the Fed gets inflation somewhat under control, but it's going to run hotter than it has been, for the past long period of time, certainly longer than most analysts have on their career horizon. So moving into the corporate bonds, this is a good situation for income investors in the corporate bond space, uniformly above 5%, and in some cases we're getting near 6%. That curve has also come down pretty dramatically over the past month, with 10-year paper coming down about 60 basis points over the past month. So these are significant moves lower, and in the corporate bond markets, that's driven by two things. Number one, they're priced off of the Treasury. So as the Treasury bonds move lower in yield, so do the corporates. But also credit default risk that's inherent in corporate bonds is priced in as well. And that may be increasing as we see more and more signs of a slowdown in the economy, potentially smaller corporate margins, potentially declining sales. So the risk premium may in fact increase, and certainly with rates where they are now, companies are facing a debt wall over the next couple of years where they may have issued the last time lots of debt at low rates around 1 or 2%, and now they're having to refinance at 5 or 6, which will impact company's profit in terms of the interest expense line on the income statement. So we're watching that too. The market's watching that. But stepping back, what's happening in the S&P 500? Well, this looks pretty strong, and we wanted to step back this time and look. Let's take a peek over the past 5 years instead of just the past 1 year that we typically start with. So it's been really eventful. Going back to 2018, we had a very nasty December, which we don't think we're in store for again this year. That led to a pretty good bull run throughout 2019 until COVID hit and everything shut down, and that was this abrupt spike down here, which led to a very strong bull market ending at the very end of 2021. And we had an official bear market in 2022 coming back and moving. The market appears to be moving higher and staying higher. This was a bit scary earlier in the year when we had another drawdown, but we've firmly moved back into an upward trajectory in this market, and volatility has been declining. So volatility expectations throughout the year spiked on a few occasions, and anytime that number is above 20, this VIX index, that indicates stresses in the market are, what the forecast is. And when it's down low below 20, that indicates all cylinders are firing as expected. They're expecting relative placidity in the market. And that's all well and good, but if you look at this chart, it tends to spike when it moves higher. It does not just generally trend higher. It tends to move higher very sharply in spikes due to some exogenous shock to the system. So we're looking to see, potentially what could happen in the future that could cause volatility to spike. And what do we have? We have a war going on in Europe. We have another one going on in the Middle East, either one of which could create some type of black swan event. We also have a weakening economy that could increase volatility expectations. So we're watching that, but for now, the situation is pretty calm. And, even in the shorter run, past 5 years, the situation looks pretty good. Over the long term is really where we want to be, though. As investors, we're not even investing for a 5-year time horizon. We're looking at 10, 20 years plus. Over a long-term horizon, the disciplined approach and sticking with it is what's most important. We've said this and we'll say it again. Here you're looking at the financial crisis in 2008-9, which we thought the system was going to break, and it didn't, and moved higher. We've had various shocks that look like tiny little blips since then, and even COVID doesn't look very big in relative to the magnitude of the move higher after COVID. So we're taking a disciplined approach. We're not making changes to our long-term plans that are based on good long-term assumptions, based on whatever's happening in the short term, like an expected recession. That recession, if it does come, is not expected to be very deep or enduring. So we would say continue to stay the course is the right move. If you're having questions about the economy and how all these pieces of the puzzle fit together, how it fits with your portfolio, if you have questions about your holdings or your strategy or your goals, feel free to reach out to us. We're happy to help and we're happy to talk. I hope you've enjoyed this video. Have a great day.